It is the 22nd of March, 2023. I'm Stefan Angelini from Angel Advisory. Thanks for joining me for another economic wrap. Well, there's a big news in the economic weather around. What are we going to go through today? We're going to talk about the losers from the Credit Suisse fallout, or the takeover from UBS. We'll talk about the winners as a result of we'll call it the new GFC, or the financial crisis that's happening with a lot of the banks falling out. We'll talk about why bank rates may increase simply because of the funding that they're getting is increasing. The cost of the funding might be increasing. How bad? We'll look at how bad is the current environment and how bad is the financial system at the moment. And then we'll look at the big shorts too. So quite a good little episode to unwrap things, just to keep you up to date with what's going on around the world. Now, if you want to listen to the full episode of this, head on over to our podcast, search for Real Wealth with Stefan Angelini. You can find us on YouTube too, or Spotify. And if you are hanging on for the full episode, guess what? Here's a disclaimer. This is just general information. Please don't consider it as personal advice. If you want any personal advice, please go and consult your licensed financial planner. Now, we will be mentioning some stock names in this series. Just remember that I'm just reading off an article, basically. I'm not making any recommendations, but if you want recommendations on your own portfolio, please reach out to a licensed financial advisor. So let's get into it. Who are the big losers from the current situation and what's happening around the world? So you would know that UBS recently bought Credit Suisse. So they call it a mega merger. Credit Suisse tried to call it a merger. UBS said, no, we're buying them. We're taking them over. But basically, so they bought them for about 4.8 billion Aussie dollars. Now, this basically the cost that they bought it for was at a 59% discount to what the Credit Suisse actual shares were selling for. So 59% discount, look, that's quite a win for all the UBS holders or for UBS in general, but for anyone that held Credit Suisse shares, not a very good thing. So it gets worse. So if you're an equity holder, that's not too bad. Yes, you lose 60% of the value of your shares. You get UBS shares now. But where the real losers are these people that actually had tier one bonds issued by Credit Suisse. There's $16 billion worth of these bonds that were out there. So the way this works, if you don't know, is Australian banks do it all the time. They issue these tier one bonds or security notes, or they call them hybrid securities, where basically they come out to the market. They say, we want to borrow money from you. We will pay you we want $100 for one stock. We're going to give you that money back, and you're going to earn an interest rate along the way at a premium to the current cash rate, right? So they say that these are quite secure. There's different levels of the capital stack as well. But a lot of these bonds, they're actually equity. In theory, they are equity. So what's happened here is UBS has said, we're not taking over these bonds. These are actually convertible bonds. They can be converted to stocks or just gotten rid of. So a lot of what UBS has said is that, well, we're not going to give you anything back for these. So it seems like they've been left with nothing of these tier one bonds. So all those people that held these bonds, which they thought were quite a secure product, now have absolutely nothing. And it's actually been better off holding the actual equity or the stock, because you still got 40% of it left. So if you had $100 of it, you still got $40 left. So yeah, really big hit on the chin for these bondholders, but just sort of it's an alarm bell for everyone out there that holds these hybrid securities. Now you might know that on the Australian Stock Exchange, they might have 5 letters, so like ANZPD or something like that. It's the same issue. They're issued the same way. They have the same characteristics. And that's why if you are going into these things, while there is quite a decent interest rate attached to these, just fully understand your credit risk that you've got here. Then we'll look at the winners of the current, issues that's going on with the banking crisis that's happening right now. Gold. Seems like gold's on a bit of a tear. Gold just the other day threatened 3,000 Aussie dollars per ounce, or 2,000 US dollars. Now, a lot of agencies are now predicting that gold's going to get even stronger. And I love this little part here. So gold has been unloved for almost 2 years, but investors are now rushing back to gold, and forecasters have grown increasingly bullish as a banking crisis sends them running for the safety of their mummy's arms. Basically saying that, well, gold is your mummy's arms. So Fitch is a massive research house for gold, have indicated that they think that the price per barrel in Aussie dollars will be around about $3,000 per ounce, which is record levels. And they see it sort of remaining there. Bloomberg, on the other hand, who is a really large rating house, have said that, well, Fitch has said that the US price per ounce will be $18.50, or to top out $2,000 per ounce, which is 3,000 Australian dollars. Instead of $2,000 per ounce, Bloomberg has said it will reach about $18.50 per ounce this financial year. It may go up, it may go down a little bit next financial year, but by 2027, it'll fall to around about $16.88 per ounce. So what's that? That's a 10% decrease to where it is today. So as they see confidence coming back to markets, they see the price of gold falling. So just a reminder that people normally run to gold in times of uncertainty because of its fixed nature. Now let's look at Aussie banks. What's going to happen with Aussie banks given this global turmoil amongst different banks around the world, especially the Credit Suisse, for example. Now, what's happening is sometimes local banks need money to be able to lend out to individuals like you and me. So they go to wholesale markets where you've got likes of Credit Suisse, UBS, who get cheap funding from other reserve banks around the world if they can't access this from the Reserve Bank of Australia. Now, if you think of all the way back to COVID, the Reserve Bank issued something called a term funding facility where they gave everyone super cheap debt, or these big banks, super cheap debt to lend out to borrowers. And that's how we got access to this 1.99% interest rates that everyone got. Now, this term funding facility had an end date where everyone had to pay it back. And that end date is coming up. And what that means is that there's $76 billion that needs to be paid back under this term funding facility between April and September 2023. And look, quite simply, banks need to get their money from somewhere. There's an analyst by Citibank who said, look, it's becoming incrementally harder for Australian banks to raise wholesale funding, and he does expect for it to get more expensive when they have to do that. Which banks will be affected? So this guy is saying that CBA and ANZ are best placed to raise more from deposits if they need, so they won't have to go to wholesale markets, whereas NAB and Westpac are more reliant on wholesale funds. They may be impacted. Bendigo and Adelaide Bank do have a strong deposit franchise. Deposits mean people give them money, they then lend it out. And they think they've got quite strong markets there. So CBA and ANZ more safe, and NAB and Westpac maybe not as safe. And that's what this article is indicating anyway. How bad is the banking crisis? So obviously there's a lot of things going on around the world. Stock prices recently have started to come back over the last few days, a lot more confidence coming back, understanding that reserve banks are really stepping in, governments are stepping in to say, we do not want another GFC, another run on the markets like there was in 2008. So on Markets Insider, there's the Nigel Green from De Beers Group is basically saying that we actually think this is going to be beneficial for markets, with reserve banks stumping up capital, giving cheap access to capital for a lot of these financial institutions. They'll come back bigger and stronger than ever. A lot of the regulations that came into play back in 2008 are really going to put banks in good stead, and that means it's going to be quite a good period for them following this recent downturn, they think anyway. And I'm the same opinion. I don't think there's no systemic issues here. The system is not broken. It's just a bit of a recorrection, and a lot of people are getting worried on the financial sector. Now, let's look at the big shorts. So we see companies getting shorted for quite a fair bit. It's something to be worried about. The main shorted stocks are unprofitable tech, lithium, and lithium. And that's where I'm still getting a lot of questions around what's going on with tech. Do I get into lithium or do I not? It's obviously been a sector that's been hugely beneficial over the last little while, but the most shorted stocks between the 6th and the 20th of March have been Flight Centre, Megaport, BetMakers, Core Lithium, Zip, Sayona Mining, Liontown Resources, Brainchip, JB Hi-Fi, NextDC. Now, this is taken from marketindex.com.au, a nice article they've got there. So there's been huge interest in a lot of shortings for these companies, and that's where just do your research when you're actually buying a stock. While it may look cheap and it may be in an industry you really love, just do your full analysis on it, whether or not it's actually a good one to buy. All right, well, that's it from me today. Thank you for listening. You guys have a great day, and we'll see you very soon. See ya.